Welcome back to Palisade Radio. I'm your host, Tom Bodrovics, and joining me today is Chris Temple. He's the editor-publisher of nationalinvestor.com. He's going into his fifth decade in the financial industry, and he's an expert on gold. How are you today, Chris?
Well, great. Nice to be with you, Tom.
Nice to have you back, Chris. Before the call, we were speaking about what got you interested in the gold market and what drove your interest into it. Could you share a bit about that with us?
Well, the way it started, unlike with a lot of people that have a philosophical affinity for gold, and I kind of did a little bit, but hey, in 1979, just after my 18th birthday, I got licensed to be a financial planner. I got my insurance licenses, my securities licenses, and, we were a financial planning firm in upstate New York and sold insurance and annuities and mutual funds and things like that to our clients. And one of the first ones that I glommed onto for a variety of reasons was a mutual fund, which in those days, the name of the fund was actually American Birthright Trust. It's long since gone, but that was the name of the fund. It was, interestingly, a tax-managed fund. I won't go into the details of that, but the tax laws were different and allowed you to roll up income within certain kinds of mutual funds in those days and be able to kind of defer taxes on what they made. But that's not the important part of the story, Tom. The important part of the story is that fund had the foresight in those days, and this is, of course, in the days of rising double-digit inflation, the weaker dollar, gold, when it peaked, hit $850 an ounce. Oil was well up into the 30s per barrel, which today would be like $150 a barrel or more. And in those days, when the number of different mutual funds and stuff that were around were a fraction of what we have today, this particular fund, even though by definition it was a general mutual fund, decided to go disproportionately into energy and mining and gold. And so in 1979, its total return for that year was 31 or 32%. In 1980, its total return was 60%. Mutual funds didn't do that in those days. The point of being in a managed a diversified mutual fund was that if the S&P 500 was up 6% and your fund was up 11, that was the point of the thing. So this was really an outlier, and me as an 18 and then 19-year-old kid, wet behind the ears. Most of my clients, all of my clients were old enough to be my parents, if not grandparents. I'm feeling pretty good about life and pretty proud of myself and getting patted on the back. Well, then guess what happened? All of a sudden, I'm getting contacted by people saying, hey, Chris, this fund has been down the last month or two. Do you think it's time to get out? Well, I didn't know. I was, when you're a broker, financial planner, you're taught how to get the clients to fill the paperwork out and sign it in the right place. You're not supposed to understand all this stuff that you're selling. So the helpless feeling I had back then was that I didn't have an answer as to why this thing was going down. I would ask my boss. I would ask the wholesaler of the mutual fund. And just as we've heard the refrain ever since then at different times, don't try and time the market. You're in it for the long run. These things go up and down. Now, Tom, the moral of the story is that looking back, certainly, if not at that time, we know that one major change hit the financial markets and the whole equation of how everything, including gold and energy, worked in those days, when Paul Volcker decided to jack interest rates way up and kill off that double-digit inflation that we had and the weaker dollar and so forth. At the time, it was the most abrupt change in Federal Reserve policy in history. Why didn't we see it coming? It bugged the heck out of me. And I said, look, I'm never going to get caught with my pants down again. And I'm going to learn what makes all this stuff tick and be able to tell people after a big move up that it's time to get out. I don't want to do what gold bugs have done for all the years since then. They get so married to gold that they ride it up and then ride it back down. Anybody that really understood the markets and wasn't just a glorified salesman like I was trained to be should have known that as soon as Volcker started getting some traction with that rising interest rate policy, you get out of those things that went up when the contrary policy was in effect. That isn't rocket science, it's common sense. So kind of through the back door, when I saw how much gold had gone up, it got me interested in studying it. And more importantly, in a broader sense, Tom, understanding the Federal Reserve, how it works, how our fractional reserve system works, what Volcker's next move was after jacking interest rates way up, which really set the table for what we've had since.
I'd like to center today's discussion around what the effects of that Federal Reserve are. As we've seen the Fed expand their balance sheet by 2.6 trillion or 60% in the last 9 weeks. I'd like to try and understand what we see for the coming deflation, inflation, hyperinflation, stagflation. Let's define some of those terms and then what that's going to mean for gold. So why don't we start by defining deflation or inflation?
Well, sure. The memory that I just shared, Tom, was of a time when the era, which was unique to the U.S. and to the U.S. dollar, of this cost push inflation that we had in the 70s, it was coming to a close. People need to remember history that the U.S. dollar has been the world's reserve currency for, I'll just use round numbers, a century now. And that status was galvanized at the end of World War II. But by the early 1970s, the U.S. had decided to engage in much more deficit spending. We had the Johnson administration deciding that we want to have guns and butter at the same time, as the old saying went. And so the U.S. dollar was under increasing pressure globally. And in those days, the Americans couldn't do it because Americans owning monetary gold was still illegal. But foreign holders and foreign governments both had the ability until 1971 to bring their gold to the U.S. Treasury or the Fed's discount window, as the case may be, and get their debt settled in gold. Well, we were printing so many dollars, there wasn't enough gold left. And finally, Richard Nixon, as everybody knows, in 1971, closed the proverbial and actual gold window and said, that's it. Now we're going to have a fully free-floating fiat currency in the U.S. dollar. For the next ensuing number of years, through most of the 70s, the U.S. was essentially alone in running deficits as we were doing in those days. So when you saw the dollar go down, the price of gold went up. It didn't have that same impact on other currencies because in those days, the other major countries of the world were running sounder, in relative terms, certainly, monetary policy. So back then, you had this very reliable inverse relationship between the U.S. dollar and gold. The U.S. dollar went down, gold went up, and vice versa. The Fed in those days hadn't heard of quantitative easing either. So the first problem, Tom, that people have today in trying to understand inflation and deflation is that a lot of them with their arguments are still stuck in the 70s. It's like I hear sales pitches from some of those that I call the Pied Pipers of the Gold Bug Echo Chamber today in the year 2020. And to me, it's like the Rip Van Winkle, and they fell asleep in 1980 and came alive now and think that old formula still works, that defines the dollar and inflation and gold. Or, Doc Brown got hooked up with them. They got a DeLorean tricked out with a flux capacitor, and they just jumped from 1980 to today. Today, it's different in a couple of respects. First of all, that every other central bank on the face of the planet not only has screwed up their currencies, but pretty much all of them have done it worse than the U.S. has done, which is why, as often as not these days, the U.S. dollar and gold go up at the same time, even if gold goes up more in some of these other currencies. But the bigger thing, and to your question, the whole definition of what is inflation and deflation has been turned upside down. And let me just pose this rhetorical question, Tom. Let's say you and I were around, you weren't even born then, but you and I were around in 1980, okay? And we're looking around at the landscape of things. We've got double-digit interest rates here in the U.S., double-digit inflation, And in those days, we had what were commonly termed banana republics, because in a lot of the Central and South American countries, you really had everything unraveling. You had triple and quadruple digit inflation and interest rates for a while. And a lot of really smart people, even in the US, were saying that we're going to have that same thing in the US as our deficits keep going up and the dollar goes down and so forth. But let's say, Tom, that I said to you, I said, hey, yes, inflation and interest rates, inflation as we understood it back then anyway, are in double digits. But let me tell you this: I'm going to play Nostradamus, and in 40 years, we will see not a $1 trillion deficit like we were approaching, but the deficit that the U.S. federal government tells us about will be 25 trillion and rising exponentially. Yet the stock market will also be 25 times higher in value. Inflation and interest rates will be a fraction of what they are. Instead of the U.S. government having to pay double-digit interest rates to attract money, the U.S. government will be able to sell bonds for 30 years at 1.25% interest rates, and people will fight over buying whatever the Fed itself doesn't do. Now, if I'd have told you all those things were going to happen and that all of the predictions of the U.S. having the hyperinflation and collapses like they were in South America would not happen, but that we would have all these other things, if I'd said that to you, you'd have got on the phone to Happy Acres and told them to send a rubber truck for me. But that's what happened. And it's because even though Volcker, who I referred to earlier, as Fed chairman, is best remembered for killing the old cost push inflation, he set the table after that from 1982 onward for what we have had since, where all of these definitions have been changed, and inflation, as we thought we understood it, no longer originates with the Fed printing too much money and that goes into the cost of living as the average consumer would understand it, but where they were able to exponentially increase debts, exponentially increase asset prices, because all of this money the Fed creates goes first, as a first matter, into asset prices. So it's changed everything that we see today, and not just the definitions, Tom, of inflation, deflation, stagflation, whatever, but our entire business model, our entire economy has changed. When I was getting into this industry 41 years or so ago and trying to get my head around things, a lot of stuff still made sense. You had an economy, and the financial markets were a reflection of the actual organic Main Street economy. Stock prices were based on how worthy a company was of a higher or lower stock price, what their earnings were, what dividends they paid, how innovative they were. In the credit markets, interest rates were set not by the Fed by and large, but by how creditworthy somebody was. So the markets were a reflection of the economy. That has been turned completely upside down to the point where today, for numerous reasons, everything starts with the financial markets, and the Fed injects as things have gotten more and more and more stretched, and we're all more and more saturated in debt. The Fed has to print all of this new money in one form or another and create all these credit facilities, keep interest rates suppressed, and keep Wall Street levitated as a first matter, and hope that now trickles down so that Joe Sixpack and Sally Soccer Mom have some decent kind of existence. So it's backwards, but that's what we have today. And so when you have people talk about inflation and deflation, I in all of the stuff that I have, lots of stuff on my website people can read, including Volcker's history, which is incredibly important to understand. You first have to understand your terms. And a lot of people still, as I said on this subject, especially those that talk about gold, they're still stuck 40 years ago.
Before the call, we were chatting about trying to understand these terms as they exist in 2020. So can you give us a look through that lens of how how these different, let's say, market environments are to be understood in this time?
Well, sure. Again, you need to keep in mind, first of all, that the traditional business cycle has been replaced now by a Fed and other central bank engineered credit cycle. We saw it in the early 2000s, where between China on the one hand and the Fed keeping interest rates low on the other hand, you had a boom in commodities, you had a boom in global growth, but it was fueled by debt more than it was by consumption demanding those things. So you ended up with too much capacity, too much goods out there, and too much productive capacity. And so that monetary inflation led to a bust in 2008. Well, then they circled the wagons, decided to come up with quantitative easing. They kept interest rates suppressed, and everybody's frantically hitting those tire pumps and computers to try and put air back in things. And it started to run asset prices up again, until we got to the present time when, triggered by this virus scare, we saw the deflationary dominoes start falling again. So, the inflation and deflation that we see are all a function of money and credit, how much money the Fed puts out there. The trouble with this, Tom, is that as time has gone on, each time we've gone through one of these cycles, the organic economy just gets more and more lethargic. It's sicker, because we get to the point, we're long since there, where it doesn't matter what the cost of money is. If you're already in debt up to your eyeballs, you don't care what the Fed sets interest rates at. And especially now that we've all had the daylight scared out of us, that we're all going to die if we go out, we don't do it the way Dr. Fauci and Dr. Birx tell us to do, that now there's going to be a lot less consumption, even beyond the conservatism that a lot of people were adopting before we got into this virus environment this year. So, and I hope I'm not rambling too much. I'm getting to what you're trying to get out of me on this. So you look at the credit that has been created. Let me just use a current example. We have, once again, like we did in 2008 and 9, in the Fed and the other central banks' responses to the financial crisis back then, we've got people telling us that the Fed and the European Central Bank and all the rest of them are going to give us hyperinflation because they're printing all this money. The government's spending all this money to try and save us from this latest crisis, that we're finally going to get hyperinflation. No, they're fighting off partially the deflation that came about from the hyperinflation we had from 2009 through very recently. Does that make sense to you, Tom?
Yeah, I remember when we were kind of speaking about this before, to really define the hyperinflation that you're speaking of, that seems to be more in the asset price and the equity markets that we've seen that inflation really take place, let's say as a ratio compared to the consumer price inflation as we've seen it, correct?
Absolutely. I mean, a gallon of gasoline recently cost me what it did when I was pumping it 40 plus years ago in high school. Okay, so don't tell me there's hyperinflation there. And in fact, that's a perfect microcosm, Tom, of what the point I'm trying to make here with understanding inflation and deflation as what it's been for the last 40 years, these credit cycles and so forth. When you look, and I'm talking specifically now about the U.S., when you look at the production capacity that we have in the oil patch down here, that's been in the news a lot in the recent past, the U.S. now, especially under President Trump, who says, you listen to him, this was all his doing. We didn't produce a drop of oil before he was president. Now we're the biggest in the world. You had a situation come about where there was so much money and credit sloshing around there in hedge funds and the shadow banking system and so forth, thanks to the Fed, that was looking for home, that they shoved it all into the energy space. And energy companies now, relative to pretty much any other part of our domestic economy down here, are the most over-indebted and the sickest of any industry that we have. I mean, now the cruise lines and hotels and restaurants are probably sicker in relative terms, so they lost the lead in that. But the point is that when you have hyperinflation of credit and too much credit out there, and it causes these imbalances, like with energy, that hyperinflation inevitably leads to deflation. And then the central bankers have to bring out even more inflation to try and save it all. You follow me?
Yep. Wouldn't gas be like a gallon of gas be kind of a bad example in this environment, considering that we've had the oversupply glut and that seems to be what drove prices down? What about like food prices?
Oh yeah, I'm not trying to say it's across the board with everything. There's a lot. I'm using that as an example more of credit than about consumer inflation. Look, we're going to see, and we already are in some ways, prices recover and maybe run higher for a lot of stuff, not because of demand, but because of shortages. You know, one of these days you and I will talk about the uranium market. Perfect example. The uranium market and its bear market since 2011 went through a lot of pain and a lot of shaking out that the gold sector needed to and still hasn't. The higher gold price is going to save some zombie companies, but now we're at a place where you legitimately have shortages of uranium coming up, and that's going to drive this unfolding bull market in uranium. Back to the opposite example, though, I was thinking about trading in my 2017 Ford Fusion while it still only had about 35,000 miles, or whatever I got on this thing, and trading up, get a 2020 before the 21s come out this summer. I'm probably going to wait now because there's going to be such a glut of automobiles that at some point we're going to get to a place like the cartoon I've been circulating recently with a couple of guys at the car showroom says, buy an oil change, get a free SUV. Because there's a glut of cars now, like there's a glut of oil. Housing is going to be interesting this go around. It's not going to get hit in a broad sense as badly as it did in 2009, 10, and 11, but it's certainly going to stop going up in a lot of places at the least. So there are going to be a really weird reactions to a lot of different things and a lot of different prices of things. And again, where there's going to be inflation legitimately that consumers are going to see, and you're absolutely right on food, because of broken supply chains recently and a lot of stuff, it's going to be the worst of both worlds. That you're going to have deflation of assets that people have most of their money in as investments or the main needs of life, whether it be real estate or their car, maybe their retirement plans if it's in the stock market. We don't go back to new highs right away. And the stuff that is consumable stuff that they have to spend money on constantly, that's a lot of the stuff that will at some point start going back up in price. So it's going to be an ugly version of the stagflation we had in the 70s, where you had a weak economy and rising living costs. But back then, the average American was far better equipped to be able to deal with that than what we have today.
Right. So let's tie this back into the environment that you see right now. How do you think the next, let's say, put a timeline on it, 12 to 18 months, how is this going to unfold? Are we going to see an inflationary environment, deflationary environment? And then once we get through that, we'll tie that back in and really try and understand why gold is a good hedge in either environment.
Well, I've been thinking that our choices were going to be one of two things, Tom. Either number one, the Fed for all of the money it's printing, and one of the things that is undeniable is that they have already early on gone far beyond what the response was in 2008. So that argues against a full-on deflation that will stay with us for a long time. And I'm talking in a broad sense. The stock market goes down 50%, real estate goes down 30%, and we have a multi-year perhaps recession or even a depression. That's still possible. But that now is the lesser possibility because of the heavy policy response. More so, we're going to have kind of a stagflation environment going forward. And again, it doesn't matter how much money the Fed prints. It doesn't matter how many fiscal measures at this point in time, at least, that Washington trots out. When you already have an economy that is saturated with debt and is in no position or no mood or either to take on a lot more debt, which is how our economy works these days. Everything starts by issuing new debt. You can't do it for one reason, things are gummed up, then you can't have a strong economy going forward. So I think that as far as the extremes, and I'm speaking in general terms, the people preaching that we're going to have hyperinflation like in Weimar Germany on the one hand, and on the other hand, those who say a full-blown deflation is going to be unleashed and we're going to have the Dow go back to 1,000, gold's going to drop to $400 an ounce, we're going to go back to the Stone Age and make the Depression in the 1930s look like a walk in the park. Both of those extreme camps are going to be disappointed because we're not going to have either of those scenarios. We're going to have something in the middle that we need to figure out how we're going to slug our way through. And in the near term, a lot of that's going to be determined by whether there is still either an actual reoccurrence of this virus that the public health officials are able to scare us all with again and force renewed shutdowns and really send the economy reeling. Which means that we get more of a garden variety bear market in stocks and deflation, or we don't. Not that we don't have to look over our shoulder for other things. I mean, I still insist that what's going on in China right now is as capable of causing global deflation for years as anything. But the markets in the recent past, as you and I know, seen a stock market rally. They couldn't care less at the moment about China. So, going forward, I don't know. My near-term view is that I believe for now that this bear market rally that we've had from the bottom should be over. We're up against the 200-day moving average for the S&P 500, just a sliver below the 3,000 level. But hey, the old saying is that the markets can remain irrational a lot longer than short sellers can remain solvent, or I'll add sane. So who knows? All of this money, and if no other shoe drops right away, we could punch through that resistance and get the further blow-off rally here, and maybe in the end make a double top for stocks before we have another downturn again. I don't know. I think the best that we can hope for is that certainly in real terms, the stock market is going to tread water and go sideways for some time to come. Maybe it won't fall completely out of bed, but I think people are really out over their skis if they think that we're going to bounce back so easily from the self-inflicted damage to the economy of the last few months that we're going to just go roaring back to normal. There's not going to be any roaring back to normal.
So, Chris, as we kind of think about this, does the U.S. dollar as a world reserve currency and the demand for those dollars throughout the world, does that serve to kind of dampen the effect of all this money printing?
Well, it does to some extent for the U.S. I wrote back around the 1st of March, that's on my website also, a fairly controversial piece to some people called "This is Not Your Father's Gold Market." And one of the things I warned of in there is that a lot of these people that are almost pining for the end of the dollar as the world's reserve currency had better be careful what they wish for, because our standard of living in the U.S. would be annihilated. That would be the point where we would, have hyperinflation. And if you really believe that we're getting near that point, Tom, or anybody out there listening, and you want to be a first mover in what'll be a really fun business to be in and profitable one, get into designer wheelbarrows. We're not going to drab wheelbarrows around like they did in Germany 100 years ago. Sell marketing rights. Put your favorite band or your favorite rock star, sports team, or whatever the logo. Sell the rights to have their logo or their name or their website on your wheelbarrow. That's what had happened if the dollar went away. But look, right now, the problem of the strong dollar, which is still in an upward channel it's been in for 2 years, despite everything the Fed has done, that should tell you something. And what it tells me is that deflation scenario is still on the table that I referred to a few minutes ago. The strong dollar is not hurting the U.S. very much, nearly as much as it's hurting emerging market nations, companies, and quasi-state corporations in emerging markets who have just since the end of the global financial crisis 11 or 12 years ago taken on somewhere is approaching $15 trillion of new dollar-denominated debt, and it's killing them. You'll know that the Fed has really gone above and beyond the call of duty when you see the U.S. dollar index for a sustained period of time drop, and it has not done it yet. And in fact, if you look at the dollar on a trade-weighted index, it is higher now, Tom, than it has been since the mid-1980s, when the dollar was so strong and causing so many imbalances that as a sidebar of the World Bank meeting that particular year, they got together with what was called the Plaza Accord. And there was a coordinated effort between, primarily in those days, England, Japan, Germany, and the U.S. to, in a planned attack, knock the U.S. dollar back down. And they succeeded so much that it caused a bubble that led to our stock market crash in '87, which was brief, but a bigger bubble in Japan that led to their yen going stratospheric and their Nikkei Dow average approaching 40,000. And when that all busted back in 1989 for the stock market and the early 90s for Japan's real estate market, neither has ever recovered to this day to what they were when they started losing their air. So there's talk that there's going to be some kind of a global effort, a global reset, something to stop all of these interplay between currencies. Maybe that sounds good to some people theoretically, but as a practical matter, that's one of the last things that's going to happen, because one of the things that was already underway before this virus situation, and especially the acrimony against China, accelerated things, is there's already a generational move to unravel globalization and international cooperation, not make it stronger. So there is no way that you have the environment today that led to that, currency meeting between several countries back in the mid 80s. It's not going to happen. So the danger, Tom, still, despite all of the money printing that everybody is engaging in, is that whether it's China, which is the big fish, Hong Kong, which is the most leveraged financial center on the planet and is under new stress, or some lesser emerging nation, which straw is going to break the camel's back and cause a cascading deflation of dollar-denominated debt? Because I'll tell you what I've been telling everybody recently, and again, despite some of the Pied Pipers of the gold bug echo chamber and some other ones out there who say the dollar is going to, turn into toilet paper next week, I guarantee you that under current circumstances and a lot of the dangers that are still out there, if there is a surprise big move in the U.S. dollar, it's going to be higher, not lower. And then the Fed's really going to have to start adding another zero or two to all these programs they're trotting out to break its back.
So typically, the dollar going higher isn't necessarily correlated with a higher price in gold. Do you think that's still going to hold true going forward?
Well, look, I said earlier that a lot of these arguments and the way that people look at the gold price, they're stuck back 40 years ago, and it's especially true with that. In the last 10 years, there have been as many times that the U.S. dollar and gold have gone up in tandem as when they have not. That's been true for the last year and a half. Gold was 1,100 and some change, and the U.S. dollar index was at a low. And for 2 years now, nearly, or at least a good year and a half, the U.S. dollar and the gold have trended higher together. Now, again, some other currencies have already set new all-time highs because those currencies are weaker even than the dollar is. But this goes to understanding the reasons for gold's moves, and they have changed over time. They've evolved over time. Once upon a time, when it was a simpler world, Tom, if you take as 100% total gold demand, 2/3 of it was for fabrication and jewelry and industrial use. The other third of it was monetary/investment. It was that way for a long time. Now you're in an environment where, thanks to this virus, although the latest World Gold Council numbers that I warned about weren't as bad as I thought they were going to be, the pattern that I predicted has come about. That today in the market, gold is almost entirely beholden to what investors think about it. Demand for jewelry in places like India and China has totally fallen out of bed. It's not nearly what it used to be. Central bank gold net buying has come almost to a halt, not quite. And again, that's less bad than I feared it would be. But the heyday of central bank buying for gold is in the rearview mirror even right now. So you've got to ask yourself when it comes to this, why are people who were never gold bugs? Why have they made the decision at various times in the last year and a half in this $500 or $600 an ounce move for gold? Why have they made the decision to buy? And it has nothing to do, to this point at least, with the reasons why people bought gold in the 1970s, which was all about U.S. dollar weakness, the deficit's too high, and inflation and that kind of thing. Gold, as I called it, in that gold-centric report that I put out around the 1st of March, is the uncurrency, Tom. Years ago, 7-Up used to run commercials, we're the uncola. That's how they distinguished themselves. That was their marketing shtick. Gold is the uncurrency. It is better than the fiat currencies. It holds its value. Of course, the biggest knock against gold in mainstream investment circles for a long time was that why do you want to own gold as an asset class? Doesn't pay any interest. Guess what? A lot of other stuff doesn't anymore either, with the central bank suppressing interest rates. And that's where that's where the real suppression is. I listen to all these cockamamie theories out there. When gold doesn't go up every single day, you got somebody coming out and saying, oh, there's this conspiracy to suppress the price of gold. Folks, anybody tells you that that's an excuse for gold today, don't walk away, run, because they're selling you a corny sales pitch and have utterly no understanding about how markets work. It makes perfect sense to get back to the original point, though, today, that gold has gone up at the same time the U.S. dollar has gone up, at the same time Treasury bond prices have gone up. And again, where the Treasury market is concerned, certainly that is where the Fed has its thumb on the scales. No question about that. That's what people should be looking at instead of this phantom price suppression where gold is concerned. So in all of those cases, it has been a deflation and weak growth and fear trade has been the dominant factor driving the gold price up from its low. Now, the question is, which we don't have the answer to yet, at what point might that, if the Fed really goes nuts with money printing and we do have deflation's back broken and we see, in a broader sense, commodities start to recover, when will gold go back to being a play on inflation / weaker currencies, which would include the weaker dollar? And we're still in between those two things, in my view.
So I hate to put you on the spot, Chris, but what could we see for the price of gold going forward here?
I have forever taken a position that I don't set price targets. I don't start from the position that I think gold is supposed to go up because that's my philosophy. A lot of people with that philosophy, they didn't get out of gold, and especially gold and silver stocks in 2011 like I told people to. So they wrote all of this stuff down. They had 5 or 10 cents on a dollar left, in recent months when finally things are going back, and now they feel better about life because instead of their portfolios being down 90%, they're only down 60%. I don't like doing things that way. Look, I believe that you look at every market dispassionately. You cannot look, whether it's stocks, whether it's bonds, the dollar, gold. Don't do it with preconceived notions. For God's sake, don't start your analysis with some of the nonsense out there of next week the U.S. dollar is going to be gone and we're going to be using a new IMF currency to buy a cup of coffee. I mean, again, run away from those people. Don't just walk. But I simply look at the preponderance of factors out there. What are the factors that in late 2018 made me get bullish about gold again? And back then it was basically as Jerome Powell decided that he can no longer normalize monetary policy, and he ran up the white flag and said, okay, all of that stuff I said about unwinding the Fed balance sheet, raising interest rates, forget it. I'm done. I'm not going to do it anymore. Forgive me, please. That was the turning point. And he did that in an environment where you've still got currency crises looming everywhere. Don't forget, Tom, that before we got to the recent past and the Fed unleashed, and I've made the joke for a while now, we've graduated from helicopter money. Ben Bernanke was helicopter Ben. This is cargo plane Jay. He's up to cargo planes. Okay. Next is going to be they're going to get all of those monstrous spaceships out of mothballs buried underneath the desert in Nevada. Well, we'll break those damn things out if we have to, load them with dough and get them in the air. So, that's where we're at. So despite all of that, what started happening? What did the Fed do last September as far as a shift in monetary policy before we ever heard of this coronavirus? What did they do? You remember that?
You're putting me on the spot now.
No, I mean, I'm putting you on the spot. What did the Fed do? And this is only going back to September. What did the Fed have to fix a plumbing problem with? I'll give you a hint.
Interest rates.
No, it was a repo market. Okay, because all of a sudden, overnight markets were starting to seize up. And last September, and again, this is with the stock market going up. This is with everything at the time looking pretty good. All of a sudden, we get this, bombshell from the Fed, or bombshell to those of us who are following it, that, we're going to start these overnight operations to shore up the repo market. Well, we didn't know the repo market needed to be shored up. So you already, from all of the money printing, all of the debt, all of the imbalances that the Fed and other central banks have created in the last 10 years, it was already starting to get under stress and seize up before we even got to this year. And my belief is, this is a whole other subject. I don't want to get far afield here, but whatever people believe about how this virus came about, why it did, who's responsible, who's not responsible, and whatever, I make the simple comparison to September 11th, 2001. That there's all kinds of theories about that incident that hit the Twin Towers in New York City and the Pentagon in Washington and all of the other stuff associated with that. It's not my job or really my interest to engage in the theories and forensic investigation of who did it, who knew ahead of time, who didn't know ahead of time. But what we can agree on is this. After 9/11, that was seized on as an excuse to do a lot of things for the markets, the deep state, the security state, Big Brother, that they would not have been able to do otherwise without that as an excuse. Likewise today. The Fed is doing things that it was already starting to do last fall. Massive new monetary tinkering and quantitative easing and money printing because things were already unraveling before the average person even knew it. And they would never have been able to get away with the stuff they've trotted out recently if we didn't have this crisis as a justification, to the point where there's nothing in the end that the Fed won't buy to try and at least slow the bleeding down. And Tom, if you're a card player and you're playing poker with your buddies tonight and your buddy Charlie goes all in on a hand or claims to, but he didn't have the cash with him and he just hand writes an IOU if he loses a hand, pretty soon you're going to be able to give that to Jerome Powell and he'll monetize that debt also.
Excellent. Well, let's leave it there for today. We're definitely going to have you back, get your views more specifically on uranium. You have a very interesting view on why silver isn't correlated with gold as a lot of us think it is. Why don't you tell us where we can find you, like your social links and your website?
Sure. Just go to nationalinvestor.com as my website. There's numerous things, the gold report I referred to, a couple of pieces talking about Jerome Powell and contrasting, or really comparing, not contrasting, his trajectory while he has been Fed chairman with Paul Volcker. Very, very important history lesson that you need to understand, again, to get your heads around these inflation definitions that we have today, and realize that we can't stay stuck in how these things were defined, but, how they are today. As far as social media, you can find a National Investor on Facebook and Twitter. I spend the majority of my time and effort on Twitter. and it's at, of course, the at sign, NAT Investor. So at NAT Investor.
Perfect. And we'll have all of those links in the show notes. Thanks for your time today, Chris.
Hey, my pleasure. It's been fun. I look forward to the next time we can visit.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?